Hey everyone! Welcome back to the channel. Today we're kicking off part 1 of a 2-part series where we break down the 3 most important financial statements every investor, business owner, and smart money-minded person should understand: the balance sheet, the income statement, and the cash flow statement. No stress, no confusing math, just clear explanations so you can read financials like a pro. Let's jump right in. Section 1. What are financial statements? Financial statements are like the health report of a business. Just like a doctor checks your heart rate, blood pressure, and temperature, these 3 statements check the financial health of a company. The balance sheet shows what a company owns and owes at a specific moment. The income statement shows whether it made or lost money over a period. The cash flow statement shows the actual movement of cash in and out of the company. Think of them as wealth gives performance gives cash reality. Section 2. The balance sheet. Let's start with one of the most misunderstood statements, the balance sheet. This statement answers one simple question. What is the company's financial position right now? Imagine taking a picture of your finances at this exact moment. That's a balance sheet. 2.1. What's on a balance sheet? The balance sheet has 3 parts. 1. Assets, what the company owns. 2. Liabilities, what the company owes. 3. Equity, value that belongs to the owners. The golden rule of the balance sheet is assets equals liabilities plus equity. But don't worry, you don't need to memorize equations. Just remember this: everything a company owns must be financed either by debt or by the owner's money. 2.2. Assets. Simple explanation. Assets are resources that help the company make money. They can be current assets, cash, inventory, things that will turn into cash soon. Non-current assets, equipment, property, long-term investments. Imagine a bakery. The ovens, fridges, and building equals non-current assets. Flour, sugar, and cash in the register equals current assets. 2.3. Liabilities. Simple explanation. Liabilities are debts or obligations. For our bakery example, money owed for flour suppliers. Loan used to buy the bakery building. Employee wages due next week. 2.4. Equity. Equity is simply the owner's share of the business. If the bakery sold everything and paid every debt, whatever is left is the owner's equity. 2.5. Why the balance sheet matters. It tells you, is the company financially stable? Does it have too much debt? Does it have enough assets to survive tough times? Investors check this first before trusting a business. Section 3. The income statement. Now let's talk about the income statement, also called the profit and loss statement. While the balance sheet is a snapshot, the income statement is a full story of what happened during a period, like January to December. 3.1. What does the income statement show? It answers one big question. Did the company make money? It shows revenue, money coming in; expenses, money going out; net income, profit or loss. 3.2. Simple example. Imagine our bakery sells $10,000 worth of bread in a month. It pays rent, electricity, employee wages, and buys ingredients. If the bakery spent $6,000 that month, then revenue equals $10,000. Expenses equals $6,000. Profit equals $4,000. No complicated formulas. Just, here's what we earned, here's what we spent, and here's what's left. 3.3. Why the income statement matters. It shows, is the business profitable? Are expenses under control? Is revenue growing? Businesses can look strong on the outside, but unprofitable inside. This statement exposes that. Section 4. Cash flow statement. And now the statement that even many business owners ignore, but shouldn't: the cash flow statement. This tells you how cash moves in and out of the business, because a company can be profitable but still run out of cash. 4.1. Why cash flow matters. Let's stick with our bakery. Let's say it sold $10,000 worth of bread, but customers paid late, or the bakery bought a new oven for $8,000. Even if the income statement says the bakery made a profit, the bank account could be empty. That's why cash flow matters. It's the actual money in hand. 4.2. 3 parts of the cash flow statement. It has 3 sections. 1. Operating activities, cash from day-to-day sales and expenses. 2. Investing activities, buying, selling equipment or assets. 3. Financing activities, loans, debt repayments, investments from owners. This shows exactly where cash is coming from and where it's going. For point 3, why investors love this statement. It tells you, is the company generating real cash? Is it spending too much on investments? Can it pay its debts? Profit is opinion. Cash is fact. Alright, that wraps up part 1 of our financial statement series. Now you understand the basics of the balance sheet, income statement, and cash flow statement, the 3 pillars of business financial health. Financial statements explained simply. How to analyze them part 2. Section 1. Connecting all 3 statements. Part 2 of our series on financial statements. In part 1, we understood what each statement is. Now in this video, we're going to put them together, because real financial understanding comes from seeing the full picture. Imagine you're looking at a house. The balance sheet tells you what the house is worth today. The income statement tells you whether the house is earning money like rental income. The cash flow statement tells you whether you actually receive the cash or not. They work together like a story told from 3 angles. Section 2. Step-by-step analysis framework. You don't need to be an accountant to analyze financials. Here's a simple 3-step framework anyone can use. Step 1. Look at the balance sheet first. Ask yourself, does the company have more assets than liabilities? Is the debt increasing or decreasing? Does the company have enough cash to survive tough times? A strong balance sheet is like having a good emergency fund. Step 2. Look at the income statement second. Now check performance. Is revenue growing? Are expenses rising too fast? Is profit steady or shrinking? If a company's revenue is up but profit is down, it means costs are eating the business. Step 3. Look at cash flow third. Finally, confirm the truth with cash flow. Is the business generating real cash? Is it burning cash on new equipment? Is it borrowing too much? Remember, profit is theory. Cash flow is reality. Section 3. Real-life example. Let's use a simple real-life scenario without any complicated numbers. Imagine a small clothing brand. The income statement says it made a profit. The balance sheet shows it has a lot of inventory that isn't selling. The cash flow statement shows negative cash flow because customers aren't paying on time. So even though it looks profitable, it's running out of cash. That's exactly how many real businesses fail. On paper they look fine. In reality they're drowning. Section 4. Red flags to watch for. If you're an investor, business owner, or just financially curious, here are the biggest warning signs in financial statements. 1. Revenue is up, but profit is down. That usually means expenses are out of control. 2. Debt keeps increasing every year. Might mean the business is relying on loans to survive. 3. Cash flow from operations is negative. That means the core business isn't generating cash, dangerous long-term. 4. Inventory keeps piling up. Products aren't selling fast enough, cash is stuck. 5. Customer payments are late. Shows up as low cash, even if the company looks profitable. Section 5. Tips for beginners. Here are quick tips to help you build financial confidence. Focus more on trends than numbers. Is the company improving over time? Compare at least 3 years of statements, not just one. Don't get distracted by big words. The concepts are simple. And always ask, where is the cash really coming from? Section 6. A final summary. So here's the big takeaway. Balance sheet gives financial position. Income statement gives performance. Cash flow gives actual money movement. Together, they reveal the true health of any business. Understanding these 3 statements is one of the strongest financial skills you can build, whether you're starting a side hustle, buying stocks, or running a company. Thanks for watching this financial series. If you enjoyed it, hit like, subscribe, and turn on notifications. Drop a comment if you want me to break down a real company's financial statements in a future video. See you in the next one.